Two of the most common financial reports used by a business owner are your balance sheet and your P&L, or profit and loss statement. A balance sheet shows you the financial health of your company at a specific moment in time. It is a snapshot. A profit and loss statement shows how your company is operating. Are you bringing in more revenue than you're putting out in expenses, so you're profitable, or are your expenses higher than your revenue, in which case you're not profitable? Whereas a balance sheet, because it's a specific moment in time, it's going to show you what you own and what you owe. So it has your assets, which would be land, your equipment, your cash, and it has your liabilities, which are the loans you have out, the payroll liabilities you may have. So it's showing you if your business is healthy and has more assets than liabilities. Alternatively, again, the profit and loss is used more as a tool to do your cash flow planning, to decide if certain departments have more profitability, their revenue is higher than their expenses. It can help you decide where to spend your marketing dollars. Depending on how your chart of accounts is set up, it can help you see which departments are more profitable than others, which revenue streams are better than others. So it's used on an ongoing basis in management to make decisions on a daily basis, weekly basis. They can be used separately. In order to get a total picture of the financial health of the company, though, you really do need to see both. For instance, if a company has a large number of loans out, on their profit and loss, those expenses are not showing. When you go in and you take cash out of your bank to pay a loan, that whole transaction took place on your balance sheet. Your profit and loss didn't show that. So even though you were earning a lot of income and your expenses look low, you may actually not have good financial health because on your balance sheet you're carrying a lot of debt, and those debts have to be paid. So that in order to get a total picture, you have to see both. But from a decision point of view, as far as if I'm looking to decide it's time for me to ramp up my marketing, if it's time for me to hire new employees, the profit and loss is the one you're going to look at, because your profit and loss is going to show you the revenue you're bringing in and what areas you're bringing it in. It's going to show you how much you're using possibly in a cost of goods section to create those revenues, or how much is carried on the bottom in your business expenses that are not determined by the amount of revenue you bring in. So it's going to help you get a better idea of where the best place to use your money in the future, where you can cut costs, where you shouldn't be cutting costs because a revenue stream is producing. So the profit and loss is a tool I recommend using, again, on a weekly basis, and any manager should know how to pull their profit and loss for their department to see how they're operating. But all of the use that comes from financial reports tracks back to your chart of accounts. If you do not have a good framework for your accounting software in your chart of accounts, your financial reports are not going to give you the data that you need to make those kinds of decisions.